It wasn't a choice made in a boardroom. It wasn't a panicked decision by a fund manager. That move was an order executed in complete silence by a ghost in the machine, an unemotional, relentless algorithm that follows one strict set of rules. And while millions of investors were treating SCHD like a safe, sleepy, passive fund, its internal system just made a massive, active decision for them. It didn't just rebalance the portfolio, it fundamentally changed its DNA. It placed a massive, concentrated bet on one specific part of the American economy while aggressively abandoning another. The result is that the fund you bought last year is not the fund you own today. Its entire risk profile and performance potential has shifted under the hood. The question is, do you even know what bet it just made with your money? In this video, we are opening up that black box. I'm going to show you the one event that triggered this change. We'll break down the shocking new portfolio with hard, undeniable numbers. I will then reveal the specific lines of code in its programming that forced this move. And finally, we will deliver a clear verdict on whether this new, more aggressive version of SCHD still deserves a place in your portfolio. So, what exactly was this game-changing move? It wasn't a panicked decision by some fund manager or a reaction to a sudden news headline. The move was something far more powerful. It was SCHD's scheduled annual reconstitution, which took place this past March. Now, for those unfamiliar, a reconstitution is a normal mechanical process. SCHD is designed to track the Dow Jones U.S. Dividend 100 index. Once a year, that index is rebalanced. It runs every publicly traded U.S. stock through a rigorous screening process, kicks out the companies that no longer make the cut, invites in new ones that do, and then reweights all 100 holdings. SCHD then mechanically adjusts its own portfolio to perfectly mirror these changes. It's an unemotional, automated process that has made SCHD so reliable over the years. But here's the critical point. While the process is the same every year, the outcome is not. And the outcome of the 2025 reconstitution was unlike anything we've seen before. The sheer magnitude of the changes has resulted in a completely different investment vehicle. Think of it like a battleship. If its onboard targeting computer automatically shifts its primary cannons from targeting enemy ships to inland bases, the entire nature of its mission has changed, even if the ship itself looks the same from the outside. That's what just happened to SCHD. And most investors haven't even looked under the hood to see where the cannons are now pointing. So let's do that right now. The most powerful way to understand the scale of this change is to look at the fund's new sector weightings and compare them to the broader market as represented by the S&P 500. First, the tech exodus. The S&P 500 currently has a colossal 30% of its weight in the information technology sector. After its 2025 reconstitution, SCHD's allocation to information technology is now just 10%. Let that sink in. This isn't just an underweight, it is a deliberate, massive step away from the market's single biggest driver. The fund's own rules looked at the tech landscape and said no, thank you. So where did all that money go? To the second and most dramatic change, the big energy bet. As of today, SCHD now has a staggering 19% of its portfolio invested in the energy sector. By comparison, the S&P 500's allocation to energy is a mere 3%. This is a monumental overweight. It means that SCHD is now making a powerful, implicit bet on the real economy, the world of oil, gas, and tangible assets, over the digital economy. Third, the defensive fortress. The fund also doubled down on its traditional strengths. Its allocation to consumer defensive stocks, companies that sell essential goods people buy regardless of the economic climate, is now over 19%, almost 4 times more than the S&P 500's weighting. Similarly, its position in healthcare is now over 15%, significantly higher than the market average. This reconstitution solidified SCHD's role as a defensive bastion. And finally, we have the financials fade. Financials have long been a significant component of SCHD, yet after the reconstitution, the fund is now noticeably underweight in the financial sector compared to the S&P 500, as its rules-based system found fewer companies that met its strict quality criteria. When you put all these pieces together, the picture becomes crystal clear. SCHD is no longer a passive, broad-based collection of dividend stocks. It has morphed into a highly specific, strategically concentrated portfolio. Through its unemotional reconstitution, it has made a conscious decision to divest from technology, largely ignore financials, and make a massive, concentrated bet on the future of American energy and defensive consumer goods. The quiet giant has placed its wager, and now we need to understand why. This radical transformation was the inevitable outcome of a multi-stage gauntlet of unforgiving filters that make up the core of SCHD's index. Understanding these rules is like finding the source code for the fund's behavior. It all starts with a simple but powerful rule: the 10-year dividend rule. To even be considered for inclusion, a company must have paid a dividend for at least 10 consecutive years. This single filter immediately acts as a powerful barrier against most of big tech. Companies like Meta, Amazon, and Google, which don't pay a dividend, are instantly disqualified. This rule is the primary reason for the fund's dramatic tech underweight. But getting past that first gate is the easy part. The real trial begins with the 4 pillars of quality. These are the fundamental screens that every remaining company is subjected to, and they are why the portfolio tilted so heavily towards energy and defensives. The first pillar is free cash flow to total debt. This ruthless measure of financial health asks a simple question: does this company generate enough raw cash to theoretically pay off all of its debts within 5 years? This filter favors businesses with strong balance sheets and robust real-world cash generation, a characteristic that many energy producers and consumer staples companies exhibited perfectly in the lead-up to the 2025 reconstitution. The second pillar is return on equity, or ROE. This profitability engine measures how effectively a company's management is at generating profits from shareholder money. A high ROE signals an efficient, well-run business with a strong competitive advantage, what Warren Buffett would call a moat. The index demands high profitability, and again, during the screening period, the soaring profits of energy companies and stable margins of healthcare giants allowed them to pass this test. The third pillar is dividend yield. This one is straightforward. The index ranks the remaining companies by their dividend yield and focuses on the highest yielding half. This ensures that SCHD maintains its core identity as an income-focused fund. And the fourth and final pillar is 5-year dividend growth rate. This is the inflation fighter. It's not enough for a company to have a high yield today. It must also have a proven track record of increasing that dividend payment at a healthy clip. This screen filters out value traps and demands proof of a healthy, growing business that can sustain its payout. So the ghost in the machine becomes visible. In the economic environment leading into the 2025 rebalance, technology companies struggled with the 10-year dividend rule. Financials faced uncertainty that weakened their quality scores. Meanwhile, energy companies were flush with cash, paying down debt, posting record profits, and aggressively growing their dividends. Consumer defensive and healthcare companies were doing what they always do, generating stable profits and reliably increasing their payouts. The algorithm didn't have a choice. It was programmed with clear instructions and followed them to their logical conclusion. The result was not a choice to bet on energy, but a choice to bet on quality, stability, and growth. And in 2025, that bet led it directly to the energy and defensive sectors. This rules-based nature is both SCHD's greatest strength and a potential double-edged sword, as it can lead to massive unintended concentrations. This brings us to the ultimate question. What does this new, reforged SCHD mean for you? This reconstitution places every shareholder at a crossroads, forcing them to make a conscious decision about the role this fund plays in their financial life. There are 3 key implications. First, future performance. The new SCHD is built to perform very differently than the S&P 500. With its massive tech underweight, it will almost certainly lag the market during tech-fueled bull runs. However, the flip side is equally powerful. This new composition gives it the potential for superior resilience and even significant outperformance during inflationary periods, economic slowdowns, or value-driven market cycles. We saw a preview of this in 2022 when tech stocks crumbled and SCHD held up remarkably well. The new portfolio is an amplified version of that defensive DNA. Second, the new risk profile. By concentrating nearly one-third of its assets in just two sectors, energy and consumer defensive, SCHD has increased its idiosyncratic risk. A sudden plunge in oil prices, for example, would hit this version of SCHD much harder. However, this concentration also offers a more potent form of diversification away from the broader market. The biggest risk in many portfolios today is the massive concentration in just a handful of US tech stocks. This new SCHD acts as a powerful counterbalance to that risk. And third, its evolving role in a portfolio. How you use SCHD must now be a more deliberate decision. As a core holding, you are no longer buying a simple, diversified dividend fund. You are making a specific strategic bet on the long-term outperformance of value and the American real economy. As a complement to a broad market index fund like VOO or VTI, its role has become even more valuable, providing a much starker hedge against tech dominance. And for investors using a barbell strategy, pairing a growth fund like QQQ with a defensive one like SCHD, that strategy just became more extreme and potentially more effective. Ultimately, the choice to own SCHD today is a more active decision than it was 5 years ago. You are consciously choosing to embrace its new identity as a concentrated powerhouse of American energy and defensive quality. So, let's bring it all home. The quiet giant SCHD didn't just stir in its sleep. It got up and fundamentally rearranged the furniture. Its 2025 reconstitution was not a minor adjustment, but a seismic, rules-based shift. It pivoted the fund away from the technology that dominates the modern market and drove it deep into the heart of the American real economy, the energy producers and the defensive stalwarts. The old question an investor had to ask before buying this fund was simple: do I want a safe, growing dividend? But this move has changed the question. The new question is far more profound. Do I believe in the future of the American real economy more than I believe in its digital counterpart? Because with this move, whether it intended to or not, SCHD has firmly and decisively placed its bet. Now, you have to decide if you want to place yours alongside it.